Welcome back to the Daily Crypto Roundup. Today we have a heavy mix of market panic, massive institutional moves, political drama, and big real-world tokenization stories that all collide into one of the strangest phases this market has seen in a while. Bitcoin is sliding as spot ETF money rushes for the exits. The broader crypto market has wiped out more than $1 trillion in value in just over a month. One of the biggest corporate Bitcoin holders on the planet has quietly bought another 8,000 coins while everyone else is scared. The Trump family is under the microscope again over a $2 billion crypto-linked pardon. They've also just unveiled a tokenized luxury resort in the Maldives. And sitting in the background of all of this is a White House crypto roadmap that's supposed to be ushering in a so-called golden age of US digital assets. We're going to break down what's really happening with the ETF outflows, why the big money buyer stepping in right now is such an important signal, what the Trump and CZ story actually means for trust and regulation, what that Maldives tokenization deal tells us about where real-world asset projects are going, and how the policy roadmap in Washington could clash with the way this market is actually behaving. Before we dive in, make sure you're following the show on Spotify, and please take a second to leave a 5-star rating. It really does help more people find the podcast, and it lets us keep doing this every single day. Let's start, as always, with the top 10 coins by market cap, excluding stablecoins, with prices rounded into clean spoken numbers. Bitcoin is trading around $92,000. Ethereum is just over $3,000. XRP is holding around $2.15. BNB is trading around $900. And Solana is about $130. Next is Tron is roughly 29 cents. Dogecoin is around 15 cents. Cardano is sitting close to 46 cents. And finally, Litecoin is trading in the low $90 range. Alright, let's get into the stories. The first and biggest theme right now is the wall of money flowing out of spot Bitcoin ETFs. Over the last week, the US spot funds have lost around $1.1 billion, marking one of the largest weekly outflow periods since these products launched. That follows another rough week before it. And together they line up with this broader slide across the crypto market where Bitcoin is down around 10% in just 7 days, and the total crypto market has shed more than $1 trillion in value in a little over 40 days. When you see numbers like that, it's not just noise. Those ETF flows are the purest window into how large, regulated, mostly US investors are feeling. These are pension funds, asset managers, high-net-worth advisors, and family offices who want exposure without touching actual wallets and exchanges. When they pull $1 billion out in a week, that's basically the market saying, "We're not comfortable at these levels, and we don't like the near-term picture." It also changes the way retail needs to think about risk. A lot of traders had built this narrative in their heads that once ETFs were approved, Bitcoin had finally grown up, and the big money would always be there to catch the dips. What we're seeing right now is the other side of that story. Yes, institutions can create a floor, but they can also accelerate the downside when they all head for the exit at the same time. They sell faster, they sell in bigger size, and they don't care about your favorite meme coin when the risk dial is flipping from green to red across their entire portfolio. You can see the fear in the price structure. Levels that looked rock solid a couple of weeks ago are slipping. Rallies are getting sold quickly, and altcoins are taking exaggerated hits as people raise cash anywhere they can. This is classic risk-off behavior. Get out of the volatile stuff, take profit where you still have it, and wait for the dust to settle. But here's where it gets interesting. While those ETF investors are selling, one of the biggest and most controversial corporate Bitcoin buyers on Earth has been doing the exact opposite strategy. The company that's basically turned itself into a quasi-Bitcoin holding vehicle has added another 8,178 Bitcoin in just a week, spending hundreds of millions of dollars to scoop up coins while everyone else is terrified. They financed it by raising more capital, endured another hit to their share price, and still kept buying. This is the split we always talk about on the show. There's the market that trades Bitcoin as a risk asset, and there's the market that treats Bitcoin as a long-term strategic treasury bet. ETF outflows right now are coming from that first crowd. They see rising uncertainty, they see better short-term opportunities elsewhere, and they pull money out. Strategy is in the second camp. For them, This is a 20-year bet on digital scarcity, energy-backed security, and dollar debasement. So when fear is high and price is lower, they see Bitcoin on sale. It doesn't mean they're right. They could be spectacularly wrong. If the market breaks down from here and stays depressed for a couple of years, their balance sheet will take a beating, and their stock will remain under pressure. But every time they make a move like this in the middle of a correction, it sends a message to the rest of the ecosystem. Someone with a very long-term horizon still wants this asset in size. For retail listeners, the question isn't, should I copy strategy? That's not realistic. The real question is, which lens do you view Bitcoin through? If it's a trading instrument, the ETF flow and the price action are screaming, be cautious. If you see it as a multi-cycle store of value, this type of week might look like a buying window instead of a danger sign. Only you can decide which frame you're in. But you need to know that those two worlds are colliding right now. This is a good moment to take a quick break for our sponsors. We'll be back in just a moment.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
What can 160 years of experience teach you about the future? When it comes to protecting what matters, Pacific Life provides life insurance, retirement income, and employee benefits for people and businesses building a more confident tomorrow. Strategies rooted in strength and backed by experience. Ask a financial professional how Pacific Life can help you today. Pacific Life Insurance Company, Omaha, Nebraska, and in New York. Pacific Life and Annuity, Phoenix, Arizona.
All right, welcome back to the Daily Crypto Roundup. And just as the market tries to work that out, we get a wave of political drama that drags crypto right back into the center of US headlines. On the latest episode of 60 Minutes, the focus was on a presidential pardon that's caused an enormous backlash. The full and unconditional pardon of Changpeng Zhao, the founder of Binance, who only recently pleaded guilty to serious money laundering-related charges and served time in prison. The investigation raised questions about financial ties between Zhao, his companies and business interests linked to the Trump family, and some legal experts interviewed on the program described the pardon as unprecedented and deeply troubling. Now, whatever your politics are, this is one of those stories that makes regulators, banks, and ordinary citizens look at crypto through a harsher lens. It feeds into the narrative that this industry is a playground for the powerful, that people with money and access can bend the system in their favor, and that enforcement isn't always about justice. Sometimes it's about relationships. For the average US crypto holder, you're not directly affected by this pardon. You're not sitting in those rooms. But you are affected by the way it shifts the mood in Washington. When lawmakers and regulators see headlines about billionaires getting special treatment, it becomes much harder for them to argue for light-touch regulation or softer rules. The political instinct will be to come down harder, to show they're not captured, and that can mean more aggressive enforcement across the board, even against projects and companies that have tried to play by the rules. That's the backdrop. Now add in another Trump-linked story that lands on the completely different side of the spectrum. Almost at the same time, the Trump Organization and Saudi-based Dar Global have announced plans for a tokenized luxury resort in the Maldives. An 80-villa, high-end project, where ownership stakes are going to be sliced up and put on a blockchain so that investors can buy and trade fractions of the property. This is exactly the type of real-world asset tokenization we've been talking about for years on the show. Real bricks and mortar, real hotel rooms, real cash flows, wrapped in a digital layer that should, in theory, make investment more accessible and more liquid. From a pure crypto use case perspective, this is exactly what regulators say they want to see. A shift away from speculative casino tokens and towards productive, regulated, clearly defined assets with proper disclosures. You can imagine a world where pension funds, wealth managers, and ordinary investors can allocate a small slice of their portfolio to something like a tokenized resort, trade in and out in seconds, and get transparent reporting through on-chain data. But when you combine that with the pardon story, you can see why this is so politically charged. On the one hand, You have a high-profile family leaning hard into crypto and tokenization as a business model, launching NFTs, meme coins, resorts, and more. On the other, you have serious questions about whether political power is being used to protect the same ecosystem that's making them money. Again, we're not taking sides here. The point for you, the listener, is that these headlines make it harder for crypto to stay out of the culture war. And all of this is happening under the umbrella of a White House crypto roadmap that was unveiled earlier this year. A 160-page document that was pitched as the most comprehensive digital asset policy framework the U.S. has ever produced. The stated ambition is huge: to make the United States the crypto capital of the world, to usher in a golden age of innovation, and to do it while protecting consumers and the financial system. On paper, that means clearer rules around what counts as a security versus a commodity, more tailored treatment for stablecoins, stronger requirements around exchanges, custody, and disclosures, and a push to bring more crypto activity onshore into regulated structures. For developers and long-term builders, that roadmap is supposed to provide direction. If you build here, and you follow these guidelines, we won't come after you later. In practice, the reality on the ground doesn't look that tidy. ETF outflows tell us that large, regulated investors are spooked. Enforcement headlines tell us that the line between legitimate and illegitimate behavior is still messy. And political stories like the CZ pardon show that trust in the system is fragile. A roadmap is only as good as the way it's implemented, and right now, implementation looks patchy, reactive, and heavily influenced by the news cycle. Let's connect all of these threads and talk about what they actually mean for you over the next few weeks and months. First, the ETF flows and the price action. When we see consecutive weeks of heavy outflows and $1 trillion drawdown in total market cap, it tells us we are probably in a mini bear phase. Even if the long-term structure still looks bullish, it doesn't mean the story is over. It means the easy money phase is over for now. The people who bought late, on leverage, or purely on hype are being shaken out. The people still standing are either the ultra-long-term holders or the traders who know how to navigate volatility. If you are neither of those, the safest position in periods like this is often to slow down. That doesn't mean selling everything. It means not chasing every intraday wick. It means asking for every coin you hold. Would I be happy to see this draw down another 20 or 30% and still hold it for the next cycle? If the answer is no, that position might be too big for your real risk tolerance. Second, the strategy buy. You're going to see this play out in two very different narratives. One camp will say, "This proves institutions still believe. This is a generational buying opportunity. If strategy is buying, you should buy too." The other camp will say, "This is reckless, it's concentration risk, and it will all end in tears." The truth, as usual, is somewhere in between. What you can reasonably take from it is this: there are still very well-capitalized players out there who believe Bitcoin at these levels is cheap relative to where it will trade in 10 or 20 years' time. They might be wrong, but they're not guessing. They're making a calculated, high-conviction bet. If nothing else, that tells you that the idea of Bitcoin as digital macro collateral is not going away just because ETFs had a bad fortnight. Third, the Trump and CZ stories and the Maldives tokenization deal. For this audience, the key is not which political team you're on. The key is to understand that these stories will shape the tone of the conversation in Washington, in Brussels, in London, and beyond. Every time crypto shows up in a headline next to the words corruption, pardon, or billionaire, it nudges regulators towards a tougher stance. Every time it shows up next to tokenized resort, new investment model, or real-world assets, it nudges them the other way. We're living in the tug-of-war between those two images. If you're a builder, that means your job is to lean as hard as possible into the second image. Transparency, compliance, real utility, clear disclosures, and sensible token economics. If you're an investor, it means paying attention not just to price charts, but to signals like, is this project working with regulators or trying to dodge them? Is this token backed by something real, or is it just a story? Does this business model survive outside of a bull market? So, to wrap everything up for today, your job is not to predict every headline. Your job is to decide who you are in this market. Are you a trader, A long-term allocator, a builder, or just a curious observer stacking a little on the side? Once you know that, weeks like this make a lot more sense, and you're less likely to get shaken out by noise. If you enjoyed this breakdown, make sure you're following the Daily Crypto Roundup on Spotify, and please leave a 5-star rating. It really helps us grow the show. Drop your thoughts about today's stories in the comments. Let us know where you think the market is heading next, and as always, we will see you at the top.